Hey there, everybody, and welcome back. I guess we are now on part 7. So, we're going to talk a little bit about the news, the media, how it can affect stocks, and most importantly, how it can affect yourself. Because, as I mentioned before, the stock market can be very, very, very emotionally reactive to even the slightest and smallest bits of news. When we started this whole thing, we were looking at some of the same symbols here, and I was making some jokes before about, oh man, look at all that red. Like, we're just in a sea of red. And it wasn't all that long ago. And now we can see things are looking a lot better. Things are in the green. Things go up, things go down, and it's very easy to get beat up by it. And you really can't. You just have to know that that's really what you're getting into. And the further away you move from mutual funds and you go into stocks, the more you're going to have to deal with that. And I mentioned finding the right price stock is just super important because we all we all want to win the lotto. We all want to make that instant gain. And the fact of the matter is, it just doesn't work that way. Sure, there are instances where you're going to see something go from such a small price to a huge price. And honestly, that's like winning the lotto. But ask yourself, how many times have you actually won the lotto in your entire life? And it's probably not that many. Wanted to point that out. And another reason to really try to avoid stocks that are too low in price. And I mentioned before that it was like $3 was really something you want to kind of stay away of anything lower than that. We'll go right over here. And I actually typed in the word split up into the search field. And this is something that we got to talk about that's super important because a reverse split is something that is going to happen, and there's also something called a forward split or just a regular split. So what is that? I just typed in the word split, and this article came up, and it says this company announces that they're going to be doing a reverse split. So we'll click on this article, and okay, the name of the company is GURE. So I already popped that into Yahoo right over here. And this stock is currently going for 50 cents. And it has been for, well, there's a month, there's 6 months. So it points it's been at 65 cents. It's gone all the way up to 92. And now it's down to 50. So what this means is, and let's go back. When did if we scroll down here, all right, Golf announces reverse split. This is now we're looking at the article on Yahoo, and it's basically saying it's going to implement a 1 for 10 reverse split of its common stock, and it's going to kick in on October 27th, which is about a week from today. So a 1 for 10 reverse split, if you ever see reverse, just know that that's bad. You're driving in reverse. You don't want to be doing that. It's not necessarily means that the company's in trouble or that they're going to go under or anything like that. But what that means is that this stock, let's pull that quote back up and we'll take a look, 50 cents. So in a week, that's basically going to mean that this is now going to be $5 a share instead of 50 cents a share. Now, if you own the stock right now, that's okay. You're not going to actually lose any value. But if you had, say, 100 shares, they're going to reduce the number of your shares down to 10. So instead of having 100 shares worth 50 cents, you now have 10 shares that are worth $5 each. So you have less shares, but your shares are worth more money. Right. So let's go ahead and actually break the math down on that. So again, if you had 50 cents a share, which is what it's worth right now, and in this example, in 1 week, because I'm going to go back and check this, but this is just presuming that it's going to stay exactly 50 cents a week from now, which it probably won't. But 50 cents a share, and in the example I said you own 100 shares. So that means your investment is worth $50. Basic math here. 50 cents a share, multiply that by the number of shares you have, it's worth 50 bucks. So they're going to take the number of shares you have and they're going to divide that by 10 because it's going reverse. So instead of 100 shares, you're now going to only have 10. So only having 10 shares, you then are going to go back 50 cents a share multiplied by that 10, is 5. And that is going to be what what the actual shares are now worth, is at $5. Remember, you have 10 of those shares. Multiply 5 times 10, and you're right back to where we started. Your investment is still worth $50, but instead of 50 cents, the stock is now worth $5 a share, but instead of 100 shares, you now only have 10. This is a reverse split. If you remember when I said before that the value of your investment isn't going to change if it's a reverse split or a regular split, the only way to keep the math consistent, because we remember it's $50 is what your investment is worth. If you're dividing by 10 here, you're going to have to multiply by 10 here to balance it out. If you're cutting one, you've got to increase the other side by the same amount. And the other reason why this is so dangerous is that if you had bought this stock, say at $1, and you were now down 50%, in order to get your actual funds back, this is now going to have to go from $5 to $10 for you to break even, which is a big price movement, 50 cents compared to $5. And if the stock wasn't that strong to begin with, it really has just been dressed up with a pretty bow. It's a $5 stock, but really it's a 50-cent stock. So why would a company want to do that? Well, if a company stays under $1 for a certain period of time, which for the New York Stock Exchange and NASDAQ is actually about 6 months, they will actually get bumped off of the exchange. You have to have a certain minimum requirement to be on the exchange. They don't want penny stocks. Penny stocks are traded on what's called pink sheets. And the pink sheets is kind of like the Wild West. You don't have the same securities and governances that you have when you're actually trading on the New York Stock Exchange or NASDAQ. So, in order to avoid compliance issues, in order to stay in the mix, in the same pit with everyone else, a company will do a reverse split to boost their stock and increase the value of it, or to make it look like it's more valuable, and people will be more enticed to actually buy it. But what'll end up happening is that when that day happens, it's going to go to $5, and then it's probably going to end up trickling back down. So it's going to be a long-term play. It's just another reason why you want to totally avoid lower cost stocks. And just because the news and the media is blowing up and giving you all kinds of just great info about this lower cost company that has these lower cost shares, it does not necessarily mean that you're going to end up seeing the gains that you want. It's part of the normal process of when a company gets started and basically gets things going. A split the other way, so you're going to be getting more shares, but the price is going to go down, which in turn will entice people to buy more, and it'll just keep driving the price back up. So it's really just a matter of supply and demand, but I don't prefer to mess with stocks at a lower price point because of this. And the last thing you want to do is get yourself stuck in a mud, and it's just going to be real hard to dig yourself out. You'll see a company do a forward split or the regular split when they're doing extremely well and that they've actually been around for a long time. You want more shares because eventually, and we haven't talked about dividends yet, but eventually you're going to end up getting dividend distributions and capital gain payments. And that's based off of the number of shares you own. So having more shares that are worth less is far, far better. So if you see a regular split, that's a good thing, and the reverse split, that's bad. So we're going to touch more into this in a different video. We'll get into this even more. And thanks for watching. I wanted to keep this one short and just point out the difference between splits and reverse splits.